Well, hello, traders and investors. I'm back, and today is December 1st. For those of you who don't know who I am, my name is Roger Scott. I'm the head trader of Wealth Press. And what do I always say? Let's get into it right now. So, starting with the news, starting with the information, we've got a lot of manufacturing data today. Construction and manufacturing, these actually go well together. By the end of today, we're going to get a very good idea of how the manufacturing sector has been doing. And all in all, just to give you an idea, let me show you how it has been doing. If you look at the 10 major sectors, and if you look at the chart, you will see that industrial and basic materials are leading on my cumulative strength basis. And if you see here, consumer discretionary technology are not even in the second place anymore. They're now in the fourth and fifth place, and it looks like they're heading lower as we anticipated. That's telling me, though, that the market is getting broader, but at the same time, it's getting a little too hot for itself. For example, this is the number of stocks trading above the 50-day moving average in the S&P right now. We are at 82%. That's on the S&P. Now, if you look on the NASDAQ, that number, you got to see this for yourself. I want to show you this. It's at 87%. And this is a 20-year graph. Look where we're at right now. Do you see this? We're at the highest level we've been in years. If you look at a 5-year chart, look at this. This is the highest momentum levels. Now remember, there's only 100 stocks in the NASDAQ 100. And if 87% are trading above the 200-day moving average, well, that's quite a bit. That's 87 stocks. Now, if you look at the 50-day moving average, there's 80%. So 80 out of 100 stocks are trading above. And if you look here, the highs, they keep getting lower as we came off of the bounce from the correction. This is the correction that we saw in March, in April and May of of this year. How fast time flies. And this is the reaction from it. And right now, the market pulled back, and now it's back up. But I'm telling you right now, this market is having a tough time with momentum levels, and I don't know how much longer we're going to be staying at these levels. And I'm telling you, on a 200-day moving average basis, 87%, and on a 50-day, you got 80%. So you're talking 80 out of 100 stocks trading above the 50-day moving average. It'll go maybe 85, 5 more, but we're getting toppy right now on the overall stock market. We're definitely getting toppy. And if you look at the overall stock market, you will also see here that the momentum levels are diverging. And you guys seen this long enough from me before when I've seen this. Let me show you this. Look at the trend line. Trend line's going higher, right? Look at momentum levels. They're declining. That's not positive. That's negative. That's on the S&P 500. That's very, very negative. And that's telling us the market is overdue for a pullback. If you look at the QQQ, and it's in line with what I'm seeing on momentum levels. If you look on the QQQ, you will not see that. You will see that we're actually lower. Divergence is negative. We haven't made higher highs. But we are reaching overbought territory. And again, if you take the momentum levels together with if you take the internals with the technicals, it's telling us that the markets are again in a bubble and the upside is in fact limited. Now, it doesn't mean we can't stay around this territory for a while. We can, but it's still telling us that the upside is limited and we've got to be very, very careful, especially with that divergence on the S&P 500. But we are not showing the divergence on the NASDAQ because the NASDAQ can't even go that high because momentum levels are just through the roof. So momentum levels are directly impacting the NASDAQ and they're indirectly impacting the S&P via the divergence. This is something very, very important, something we need to pay attention to. Now, if you look at the news for the day, the news is very interesting. Notice how I told you guys yesterday how we're between a rock and a hard place. We're kind of between COVID-19 vaccine and infections spiking. And that's what the world is looking at right now. And every day it's going into the alternative scenarios. So global stocks, U.S. futures rose Tuesday on improved economic reports from China and as more drug makers sought regulatory approval. The S&P looks to set new record highs, but remember what I just said, it's not looking very strong. When trading opens, markets in London, Frankfurt, Shanghai, and Tokyo advance as investors look ahead to U.S. Federal Reserve Chairman Powell, who's going to be appearing today, as you can see here at 10 a.m. Sentiment was boosted after European Medicine Agency said it will convene a meeting on December 29th. That was yesterday, day before yesterday. Actually, was that yesterday or day before yesterday? Day before yesterday, to decide if there's enough data about the safety and the efficacy of the COVID-19 vaccine that Pfizer and BioNTech are coming out with. Moderna said Monday it's ready to approve or ready to apply for emergency approval in the United States and Britain. But folks, I'm telling you right now, even with the approval, it looks like we're not going to get anything till about May or June of next year if you're a healthy, normal person. The Hang Seng Chinese territory on Monday announced the closure of government offices and restrictions on restaurants and other businesses to stop a new spike of COVID. And I honestly thought that China was done with this. But remember, they were spraying bleach in the middle of the night in March of this year. The Organization of Economic Cooperation and Development said in a report that the world economy will bounce back to its pre-pandemic levels by the end of this year, though the recovery will be uneven across countries and risk remains. That's not giving us very strong indication. In Washington, Powell said in a statement Monday, that was yesterday, that economic prospects are extraordinarily uncertain. And that's what I'm seeing with this divergence and the momentum levels after the pace of improved moderated. He said a full recovery is unlikely until the public is confident the disease is under control. And I'm telling you, folks, that's not going to happen probably till next flu season. Powell was due to appear Tuesday before the Senate Banking Committee with Treasury Secretary Mnuchin. The panel oversees $2 trillion aid packaging. That's happening in about an hour and a half. And OPEC, let's talk about crude oil. Energy market, oil continues to edge down as OPEC countries remain locked. There's just too much supply of crude oil, but crude oil prices are heading higher. We're now above the price that U.S. frackers pay to work on energy markets. So we can see a little bit more of an uptick. Now, the markets are still bullish. There's still a broad-based rally, and the rally's getting broader. So I've got 4 stocks that I'm looking at that I'm going to signal your way. First, Walmart. Walmart, very broad stock. If the conditions and the economy gets worse, people are going to be shopping online via Walmart to get all their supplies, just like they did last February, March, April. But right now, we're not there yet. We're actually looking pretty good, and volatility is not increasing. And if economy improves, Walmart stands to do better because Walmart's one of those few stores that gets its business from consumer staples, things people need, and consumer discretionary, things people want. Like I just bought my kid a bike. She just turned 7. I got her a bike at Walmart. Things like that. So again, people will spend money in Walmart either way. And from what I understand, Walmart and Target really got their online order taking together during the first phase of this vaccine, and it's trading above the September 2nd high, which a lot of the indices had trouble penetrating. It's now higher and volatility's low. It's moving in a nice congested channel, and I like Walmart right now. Next one is Marvell Technology. This is a communication semiconductor. The stock is looking really good. 5-year return, 465%. If you look at the chart of the stock, you will see that it had a nice little breakout. It's now at all-time highs or near highs. Oh, yeah. It's looking really, really strong, and this is one of my favorite semiconductor stocks right now because it's got really strong momentum levels and it's near new highs. But at the same time, volatility levels are stagnant, which is good. When volatility expands too much, it's not good, but volatility is good here. I like this stock. Next one is Logistics, XPO. We've talked about this stock before many times. It's a transport stock that deals with logistics. Third-party logistics is the key, especially with this e-commerce world we're living in right now. The stock, again, and I've talked about the stock previously, it's making all-time highs or swing highs. Let's see here. Not all-time highs, but swing highs. Still hasn't taken out the previous high, but look at this thing. It's moving. It's moving really well, and it looks like the next swing will be to take out the high. So I do like it near the 110 level. Be careful, and if you're not sure, wait till it takes out the 117 high. But based on this momentum level, I think it's going to happen sooner than later. Another one of my favorite stocks is Sherwin-Williams. That's the fourth one. I told you guys this stock was going to go up when it was about 606. It's now about $150 higher, and I'm still bullish on it. Let me show you what this stock does. Paint, hardware, building supplies. Folks, residential real estate market is hot right now, and it's not going to be cooling off. People are putting their money back into their homes, reinvesting, construction, taking money because interest rates are at historic lows and putting it back into their housing market. On a weekly basis, the stock's looking great. On a monthly basis, the stock is looking amazing. I like the stock, and it doesn't have a lot of the issues associated with the economy. In other words, this stock can do really well regardless if the economy picks up or goes back to COVID-19, because people during the COVID period were still buying this stock because it's a stay-at-home stock. And again, if COVID expands, residential real estate is going to expand. People are going to be moving out of big cities into smaller cities. Companies that they work for are giving people incentive to work from home right now. I like Sherwin-Williams. It doesn't have a lot of drama associated with it. So I like Walmart, I like Marvel, I like Sherwin-Williams, and this XPO I really like a lot. And again, I like the fact that it took out this high here, the February high. But again, if you're a cautious man or a woman, cautious investor, wait for it to take out the 117 level that we saw in 2018. But otherwise, I really, really like this stock quite a lot. Logistics is the key right now. Now, folks, I've got something else for you. I've got something big for you, actually. The stock market shift I'm currently witnessing could be the biggest shift of all time. And you could literally triple your money within 1 week if you know how to get in front of it. The stocks, folks, that I've been giving, I gave a stock about a week ago. It went up 389%, Moderna, in like 3 days. There's opportunities right now. I'm not going to lie to you. There are opportunities right now. Everyday traders used to follow smart money. Now they flipped it on their head. And Goldman Sachs, Morgan Stanleys of the world are following retail traders. They used to follow smart money. Now they're following retail traders. It's crazy. It's all thanks to one little known effect that puts the power of Wall Street in your hands. That's right, your hands. Forget Paul Tudor Jones. Now you have control. Forget Morgan Stanley. Now you have control. And if you know how to use it right, you could potentially earn gains like 282% on American Express. Not Amazon, American Express. How about 230% on Intuit? How about 399% on Apple in as little as 7 days? 399% on Apple, while the S&P gives you 6% per year on average. You're talking 399% on Apple, 230% on Intuit, 282% on American Express. Folks, there's only one thing left to do. You've got to get in on this now. Follow the link below. Learn how you can understand and profit from this strange effect. See it in action. Click the link below. Don't miss out. 282% on American Express, 230% on Intuit, almost 400% on Apple. Don't miss out. Smart money is going to be following you by the time you're done here. All right? I'll talk to you guys later. Send me some comments, feedback, like this video, and all the other good stuff, and I'll talk to you soon. And have a great week. Bye.